Yeah, your take on these numbers, Helen.
Well, Yvonne, I have to say that we had very low expectations for GDP and also September activity growth indicators.
Some of the lowest estimates you said among the group.
Yeah. Yes, I'm afraid so. However, I would say other than retail sales that beat our expectation, almost everything else that you just mentioned were still below, are already below consensus numbers. So this is suggesting that the investment side of the demand is pretty weak, and the power crunch impact on the supply side is also pretty severe.
What does this tell you about the fourth quarter now then?
I think this suggests some downside risks to the current consensus and as well as our own forecast. So right now, with a very high base from a year ago, I think that we can potentially look at the fourth quarter GDP growth somewhere around 3 to 4% at least.
And the retail side of things, at least that's a somewhat bright spot. What do you think was kind of weighing on that, or at least bringing it up or boosting it?
Well, I think the very fact that the COVID impact from August was more or less diminishing, and therefore there could be a little bit of improvement from the service side. So people are going out a bit more often in September, and things got better. So the catering part of the component probably improved. But that said, I'm still worried that the large ticket items such as cars and also cell phones, home appliances are not selling well. And on top of that, property sales contractions are also hurting anything related to housing purchases such as furniture, home appliances, or for example, the construction materials.
And Helen, with the way that the Chinese economy is actually structured at the moment with so much reliance on housing and property development, a big slowdown there has a big, well, massive impact, does it not? And the thing is, when do those figures start actually impacting the growth in China?
Rich, I'm afraid that you're absolutely right. The impact of a property sector on overall GDP growth is pretty significant. According to our estimate, it's as much as 28.7% of GDP is actually coming out of property and related industries in upstream and downstream altogether. I'm afraid that we are currently already seeing that impact as the property investment slowed down, sales contracted. And it's already impacting, for example, the demand for upstream sectors such as steel, cement. But of course, that those are also under the impact of electricity power rationing. And on top of this, I would also say that the suppliers of, for example, home appliance, and also paint and other things, as well as consumer products, are all starting to feel the pain.
The trouble is it has the negative multiplier effect. That's one part of it. And then the other thing is when we look at what's going on globally, we have an asynchronous recovery taking place. With that in mind, how does PPI all play into this?
Yeah, the PPI inflation is particularly high. At the lowest reading from September is the highest that we've ever seen since the beginning of the series in 1996. The very elevated commodity prices, however, cannot be easily passed on by midstream or downstream manufacturing, companies to the final end, to consumers, because consumers are still very weak. Retail sales beat 1 month, but only by a little bit, right? We were used to retail sales being 7 to 10%. Right now, 4% is a beat. So I'm afraid that the implication is that for midstream and also downstream, manufacturing companies, they probably would have a margin squeeze big time, and they would have more trouble investing. And as a result, the manufacturing-related FAI growth is probably going to come under pressure as well.
We were just talking to JP Morgan's Haibing Zhu and saying it's not really so much about whether they can reach the 8% of growth for this year. That's pretty easy, but it's more about the momentum that we're going to see heading into next year. Do you think that's going to raise a lot of questions about the growth target next year?
I'm afraid so. Well, but the problem is, first of all, they didn't have an 8% for this year. They had a 6% for this year. So 6% is not a problem. But I'm afraid that with the number today and also the potential ones below 4%, probably for fourth quarter, we might not be able to see above 8% number for the whole year. And for 2022, the trouble is that we are currently expecting a 5.3%. So are they going to roll out the target more as around 6% or between 5 to 6%? We don't know. Even that, I think, is subject to downward pressure with the risks on the downside.
Are you losing a bit of confidence that we're going to see a triple R cut by year end now?
Well, I'm not. I think that policymakers have already seen what's happening, and they're actually now coming into a catch-up mode. So in our view, for example, look at what they said on property-related funding over the weekend. Look at how much of how many measures they have taken on power crunch. I think that we have already seen the bottom of policy cycles. So we're not expecting the policies to get tighter from here. We definitely will see easing from here. But whether they're going to cut the LPR and also the triple R, we're not sure. We hope that they will do, because it's not that how much of this would help the credit expansion, but more importantly, the signaling impact. Unless you send a strong signal to get people back on their foot, for expectation stabilization, I don't necessarily think that this is the time policymakers can remain complacent.
Helen. Okay, I mean, this is a bit of an esoteric question in some ways. We saw on Friday that we've got the PBOC urging some of the banks to relax some of their mortgage criteria. Now, with that in mind, we may not get a triple R cut, but we might be seeing and witnessing what is perhaps a gradual and managed structural change of China's economy.
Well, yes. I don't think that the overall policy direction on property-related funding has completely got reversed just because of what they announced on Friday. We do know that this came from the meetings 2 weeks ago on September 29th. But we think that in terms of the implementation of extremely tight credit controls on property sector, we think that the worst is probably behind us. Now the question is, even if that they are moderately relaxing the mortgage controls, which one of these private developers get to survive? I'm afraid that there are still tremendous funding pressure for most of them, and only the best ones can survive really well. So hopefully we can see some stabilization, but we still remain cautious.
Take a look at the PBOC comments. Yigang seemed pretty calm when
Yes.
asked about the property market. Do you think that he's right to kind of show a bit of confidence that they can ring fence this? I mean, do you see this as just an idiosyncratic risk? The Evergrande story, I should say.
I think the Evergrande story by itself can be easily ring-fenced in the sense that if the policymakers can specifically come out and say that Evergrande is by itself having some problems, but we're happy to provide funding support to the rest of the property developers, even if that they are private ones, I think that can immediately address this issue. But then the matter is whether the PBOC or CBRRC or anyone from way above would be willing to do so. The problem is not Evergrande itself, but you think about how Evergrande come to the situation today. It is because of the overall tightening. So are they going to give up the idea that they are going to push the deleveraging in the property sectors consistently and more intensively and keep it all the way despite all this slowdown? I think that's the biggest problem. The Evergrande one company is not necessarily too much of a trouble. As Governor Yi was saying, it's very diversified. Financial institutions are not all concentrated in just one company. But the issue is that would you be able to, or would you be willing to relax the policies so that financial institutions can be insulated from any further risks and other private developers can be insulated from any further risks?
Now, home sales dropping by value, about 16.9% in September, Helen. If you are seeing falling sales, that, of course, engenders pessimism, and that can create a negative feedback. So you can relax things, but if people don't actually fundamentally feel safe buying a house right now, perhaps, or a flat, or whatever, that can actually become a self-fulfilling prophecy.
Yes, Rich, you're absolutely right. I think the biggest risk right now is not just about the risk of contagion in fact, right? But also how the public expectation is going to evolve over time. So the longer they wait for sending this kind of easing signals, the longer we wait for any effective policy easing to be seen in credit expansion, I'm afraid that the worse the public expectation is going to turn. And the challenge is that, yes, you are telling the banks, oh, okay, I give you window guidance and please hurry up on mortgage loan extension. And they are releasing some of the pent-up demand because they have been holding it back for a while. But no one is buying new properties, right? Because they're getting afraid. If that is the case, then potentially we can see even further downside in property sales as well as investment and overall economy.